What are you guys doing in monthly rent roll, let's say?
So December will do about or so. And to compare that to like January of this year when our first project went live, we were doing about right.
January of
So
this year. Oh, you guys grew super fast. Welcome back to Talk Shop Podcast with me, Allon Avgi. I get messages all the time asking about short-term rentals, Airbnbs, all of that stuff, a space that I'm not too big in or dive too much into. So I figured, why not have on a special person, young guy, Sief Khafagi is his name, founder of Techvestor. They buy short-term rentals in 10 different markets across the country. Have him on, have him talk about the space since I'm not too familiar with it. And I figured this is perfect podcast because I want to learn more, right? I want to talk about it. I want to hear some insight. And when I want to hear some insight, I bet there's other people that want to hear it as well. What better than to air it for everybody else? So I hope you guys enjoy and take something from this and build short-term rental empires if that's what will fill your void. We're in Houston right now, walking our new 56 unit crazy property here. It starts down there.
We got Allon, a billion-dollar man.
I was born in England, a couple of years in Israel, and then Long Island.
great.
And this is
Great.
Robbie, the producer.
Robbie's gonna make us look and sound great. Arrow.
That he will. So since I'm in real estate as well, tons of people all the time bring up short-term rentals to me. It's not really my space, not really where I'm an expert, right? But I figured if I had somebody on, who better than yourself, right? Sief Khafagi. So what is Techvestor? Fill us in.
So Techvestor allows the everyday investor to invest in a portfolio of short-term rentals completely passively with as little as 25 grand and gets you access to this beautiful asset class of short-term rentals where you can use them, benefit from them, get tax advantaged cash flow, great cash flow, instant diversification, and you don't have to lift a single finger, clean a toilet, or deal with a single guest.
Got it. So you guys are basically like a fund, right?
Yeah,
You have a
for lack
fund,
of a
but
better
with
word.
like a tech twist.
Yeah, so we're as if a private equity firm and a tech company had a baby, because we're not your traditional private equity firm. We Sabrina and I, as the two founders, we both come from tech, ex Facebook, ex Apple, respectively, and we built our own software to run operations, acquisition. I mean, we built an entire stack on some of the more popular tech platforms in the tech world, in the real estate world. So like that's what we did as kind of our proprietary advantage, and it's really allowed us to scale in a pretty great way.
What type of returns are your investors seeing?
So we target about an 8 to 12% cash on cash, generally, with about a 9 to 10% average over a 5-year hold. Your first year is going to be a little bit lower just because we're still ramping, right? You're finding, buying, designing, furnishing, right? Getting these properties up to speed. And we generally target about a 2x multiple or so, roughly in that range, over a 5-year hold.
Okay. So this is a diversification play because those aren't like crazy return metrics.
Well, I mean, I think depends on what you compare it to, right? Everything's relative. So I think our return profile is similar to that of, say, a historical multifamily syndication, right? Or something along those lines. With us, you're going to get better than average cash flow, and then a little bit less in year 5. So it kind of balances. You get a little bit more money earlier, which a lot of people value. We're not developing, right? Like if you're looking for 30, 40, 60% returns in a short period of time, you're only going to really get that in like ground up development plays, little to no cash flow, right? That's usually what's going to happen.
Yeah. Yeah. And now you're raising everything through your portal. Do you guys have portals or do you link to third party investment management software and stuff like that?
So we don't raise directly through the portal. We have an investment portal, but we do raise capital both directly and indirectly through our partners.
Okay, cool. When do you guys put out your distributions?
Quarterly. So we send out a check automatically to your bank account every quarter, depending on whatever the performance was for that quarter. And generally we'll be on tune with the about 2% kind of return per quarter
And
or
this
better.
is all short-term rental stuff, right? You guys aren't
Yeah.
doing anything else.
Everything we do is short-term rentals. Like we personally believe that single-family homes are mispriced assets. We're taking them, developing them into short-term rentals, selling them eventually based on their revenue, just like you would a multifamily building or anything along those lines. But in the meantime, collecting better than average cash flow. And my favorite part is rolling up an entire portfolio of 50, 100, or 300 of these, and then selling them off to private equity. Because we have to remember that private equity firms, Blackstone, BlackRock, et cetera, will never do what we do. The reason is they can't spend money fast enough, right? They're not going to come in and buy a $600,000 home, deck it out, renovate it, Airbnb it, get a T12 on it, and then just benefit from it. They can't do that. In fact, they need to spend hundreds of millions of dollars a day or a month. And what they will do is they'll come buy the 200, single family portfolio that's been stabilized and give you a really great premium because they want to get to stabilized yield as quickly as possible.
Yeah, I don't even think BlackRock or Blackstone or any of those big boys would buy a 200 home portfolio. They're monsters. They put out on
I agree with you.
2,000 home portfolios. They have to put out 150, $200 million before they even, scratch the surface.
The good news is there's tens of thousands of family offices, private equity groups that are not BlackRock or Blackstone.
Correct.
That are looking for yield. What's also really unique about our strategy is we don't cross collateralize any of our homes in our portfolio. Each one is its own business, for lack of a better word, its own loan, everything, and they qualify under SBA. So in the future, we could actually sell each asset to a retail buyer who's looking for a turnkey business with cash flow in a real estate backed play with a 90% leverage loan, right?
Wow,
so
fantastic.
Those are advantages we'll be able to do in the future as one of our many exit options.
Wow, amazing. That's awesome. And why did you guys pick short-term rentals? Was it the Airbnb wave, the VRBO wave? Like, what was the deal?
Yeah, so Sabrina has been investing in short-term rentals for even longer than I was. And then when we had a chance to kind of reconnect after our days, we both were living up in San Francisco for a few years and got to know each other. But, when we reconnected middle of last year or so, we really wanted to optimize our cash flow. And we both knew that short-term rentals were very hot at the time, especially coming out of the pandemic. But we also knew that the process of getting into them was very hard. There was a huge competitive moat, like finding, designing, furnishing. Unless you're going to go do one, it becomes really hard to scale, let alone across markets. And that was a challenge to us that we thought we could solve with technology, right? So understanding our strengths, we built software that allowed us to find, source, identify, and operate portfolios in today 10 markets across the country. Wow. And operate them seamlessly, right? Like we were joking earlier because we had just come out of our portfolio meeting today, and we broke our weekly revenue record, and we'll end December probably 35% or so above projections, which is fantastic.
What are you guys doing in monthly rent roll, let's say?
So December we'll do about 360 or so. And to compare that to like January of this year when our first project went live, we were doing about $4,000, right?
January of this year, you were making
January of this year, we're doing about $4,000 in monthly revenue for our Airbnb portfolio. And in December, we'll exceed 360.
Oh, you guys grew super fast.
Very fast.
That's amazing. And this is all through one fund.
All through one fund. Every year, the idea is that we launch a new fund. So our first fund is coming up to a wrap here, and we'll launch fund two, late December, early January.
How much did you guys raise?
Live numbers is about 26 million, and we'll end fund one roughly around 30 to 35, depending on what happens here over the next 2 weeks. But generally, that's what we expect.
For fund one, two young people, unbelievable. To grow from $4,000 a month in rent to $360,000 in monthly rent roll on their first fund in 1 year, unbelievable. Well done.
Thank you. It's been an incredible ride, but I can't take credit for it. We have an incredible team. I think that's actually our biggest advantage is the people that we have. They're STR experts. They decided to buy into a vision and kind of build this crazy idea of this biggest, best, most profitable short-term rental portfolio that no one's really tried to do before. And, we can't do it without the people on our team. So we're really excited.
What type of fees does the fund charge?
The fund does not charge any fees, surprisingly. So we do have a 8 pref and a 50-50 split as our base retail level. You can
Okay.
get additional splits depending on your check size. And then our affiliate manages the properties, right, from a property management perspective. So we operate in a typical OpCo/PropCo perspective, right? So
Got it.
you have your operating company, and then you have your property company, and then of course you have like your fund LLCs and holding and all those types of things. But we generate top line revenue on property management, and then we also collect our share of the promote after we meet specific hurdles, depending on
Yep.
whatever class of share someone's in.
Well, 50. So I understand now why the metrics are where they are. 50-50 split is obviously in the sponsor's favor. That's what every sponsor wants to get, right? Like that's how I till this day raise on 50-50 splits on many of my projects. But the bigger check sizes, the monster projects, I have no choice but to go to a 70-30, 80-20, or to meet investor expectations. Probably when you guys go after the $250 million fund, you'll be looking at the same thing, right?
Yeah, we definitely this time last year, right, we got proposed a 9 and 90, right? From a private equity group, which we were like, no, we're okay, right? Like
Yeah.
we'll continue doing what we're doing. But our 8 and 50 is very similar to mathematically what would be like an 8 and 70 with an AUM fee or an acquisition fee or those types of things in terms of what the net kind of breaks down to. But really what we want to optimize for is investors first and always, right? It's a big goal of ours. But we also have to remember that short-term rentals compared to a lot of other asset classes are incredibly hard to scale, right? And so for us, the juice has to be worth the squeeze. And I think for many people who are investing in a syndication or a fund, I think you always got to ask yourself and know that the sponsor has to be able to make money in order to support this
That's big.
venture, right? And I think that's something that a lot of people often forget is it is a two-sided street, right? Is if you have a sponsor who's incredibly hungry, right, and they're not eating enough, right, they're not making enough money, that's a huge risk to you as an LP, right? Because as an LP, you need them both motivated and being able to live sustainably, right, over a period of time. Because we're not talking about a flip here that's going to take 6 months, right? We're talking about a 5-year venture where it's very easy to burn out. Mistakes can happen and recoveries can happen, but you need people who are bought in and aligned from day one, and that's what we believe in.
Well said. Well said, and I agree 1,000%. What are you guys charging on property management? Do you have boots on the ground in each of these markets? Do you sub it out, or is it all in-house?
So we're fully vertically integrated. And fun fact, when we first started, we did not want to be vertically integrated, nor did we see the biggest value in it. We thought we would just call some of the larger players in the space and be like, hey, can you manage our properties? And what we realized is no one's going to care about your asset more than you will. So we built our own vertically integrated asset management. We do have boots on the ground, but I want to just clarify what boots on the ground means in the STR space. You don't need someone there at the home or near the home necessarily to like check somebody in, right? Like everything is leveraged with technology these days,
I
with
see.
check-in
Yep.
codes and ring cameras and those types of things. So eventually in some markets where we have enough depth and scale, like would we hire a general manager? Sure. But we have enough resources between cleaners and contractors and people that we trust in most of our markets where technology can kind of self-run the assets, right? As soon as someone books a property, it automatically schedules a clean and a clean out and photos circulate. Like there's a lot of things that happen on the back end that allow us to know that our properties are in good shape. The amenities are there, all those types of things. In terms of what we charge 6% of the property purchase price per year over the first 5 years. It's a projected 5-year hold in our approach. And we invest heavily in things like technology, revenue management, and design. So one of the areas where I think we excel at, and I'll just kind of share some data, is revenue management, right? Like we can get way more juice out of the same asset than someone else can. And so in our markets today, we generate typically 52% more revenue than the average property in our market, given the same size, like a 3-bed, 3-bath in this market, in this zip code, in this little bubble, however you want to call it, will generate 50% more revenue than say, Grandpa Bob or Mama Joe, the average home in that market. And then we're generating about 38% more occupancy. So we're getting better ADRs, which for anyone who's new to this space is average daily rate, what you're able to get. Fun facts, one of our properties just booked out for Super Bowl, and that was a healthy payout. We have a bunch of properties in the Scottsdale Metro, which is where the Super Bowl is this upcoming
Nice.
year, and that was a nice healthy payout. But we always want to make sure that we're investing in technology and revenue driving ROI events.
Where did you come up with that property management fee?
So everything to us is all about structure and where the value is derived from. And so we wanted to get creative, and we had an advisor on our team. Dude has been, big time private equity, and he said, "Hey, you should consider charging PM in a slightly different way to align with investors." So as you know, generally anything that's coming out of cash flow, like let's say you have a property today, right? Your two biggest expenses in the short-term rental space on an ongoing basis is your debt service and your property management fee, right? Industry average for short-term rentals is between 20 and 40% of gross revenue. That's like traditional in the space. So let's just take 30% as kind of the average, right? That's generally where we get it from. But because we're also able to drive more revenue, our cost basis is actually a little bit lower, the structure that way we do it.
Okay. I can see that. When I was shopping in the STR space, which I didn't pursue, by the way, at all, I have one project that I might convert to an STR project, let's say, but it's a larger scale project. The property management companies I was shopping out were offering between 12 to 25%. The 12%, it was like a la carte, right?
Yep.
If you get this, then we add this. If you get this, we add this.
It's like
And
pay
then
for every line item.
Yeah, and the 20, it seemed like they hovered around like 18 to 20% for full service. I thought it was very pricey. It was,
Yeah.
it definitely was a turnoff.
The 18 to 20% too, in what I would tell a lot of people, typically doesn't come with human-driven revenue management, which is like where we excel, right? And so like typically they're using just Price Labs or some tool like Price Labs, where they're making occasional changes. Like, we have a full-blown revenue management team, right? Like humans using technology. In fact, later today, we're hoping to close our newest hire, who is one of the heads of revenue over at Picasa, that helped them take them
Oh,
from
wow.
1,000. Yeah, to help them take them from 1,000 to 38,000 doors. We have a verbal accept for him to join our team. So we're excited to continue bolstering that, right? So you're not just getting traditional out of the box kind of old school management. You're getting a boutique approach that actually shows in the bottom line. And I think a lot of people optimize for revenue, and that's a big mistake. And it's because property management companies typically are incentivized to optimize for top line revenue. But given we own all the assets in our fund and we exclusively manage for our fund on our opco side, we optimize for profitability, right? What goes to the bottom line in terms of your NOI and your take home, which is not always the same as optimizing for top line growth, right?
That's a big pickup. That
Huge pickup.
person from Picasso, that's huge.
Yeah,
Huge.
I'm sorry, I said Picasa, not Picasso specifically.
Oh, I thought
So,
you said Picasso.
yeah.
The
No,
ones
no.
that did massive layoffs.
Yes. I wish all of them well. But Vacasa actually did layoffs as well. But Vacasa is the largest property management company in the STR space. I believe they're one of the only public ones that went public as well. So our team continues to bolster there.
Wow. Do you guys accept only accredited investors?
Yes, we only work with accredited investors.
I feel like I'm shooting an ad right now, asking you layup questions to the fund.
I'm like, should I just add a video of Allon onto our website? just keep it simple.
I love it. And what's your AUM right now?
So we look at AUM simply as equity raised, right? And that's the simplest way we look at it. I know a few people look at it a little bit differently. So our AUM in live is about 26 million.
26 and raised, of course. We discussed that.
Correct.
What about an actual asset value?
We're going to be looking at a total of about 50, right? In aggregate. Yep.
What type of debt are you sourcing on these things?
Yeah, so the debt that we get is actually one of the biggest advantages in this space, and especially our investors love the debt situations. So I think you and I both know that typically most operators die because of the debt that they get, right? Especially when things come due, especially in a market like we might be in right now. So all of our debt is fixed for at least 10 years. It's interest only 95% of the time. And each property is not cross collateralized, meaning, if one property goes under for whatever reason, it doesn't impact the portfolio. And even though we're running a 5-year fund, or at least a projected 5-year fund, we have debt to extend to up to 10 years without balloon payments, floating rates, none of that. And we can always refinance at any given time that we choose to.
Are these non-QM loans?
They are non-QM loans.
Okay. I figured because you're still in the 1 to 4 family
Correct.
space. Got it. I have a good friend who's a fantastic non-QM lender, but I mean, these rate changes have threw a curveball into everything. I did with him $21 million in refinances in the non-QM space last year.
Wow.
That was awesome.
Yeah, we'll take every intro we can.
Share Estates, if you've ever heard of them.
No, we don't. But Tammy, who's my lender, if she's out there and she's listening to this, Tammy, I love you. I'm not cheating, I promise.
But he is getting quotes, Tammy, so be careful. Always keep his rates low.
Good thing is Tammy has never lost out on a quote. She's always found a way to beat it. So I think we have a pretty good relationship. She's a hard to beat one.
With that being said, I apologize to my non-QM lenders if Tammy beats your quote. I will take a better quote any day.
Fair
and
enough.
surety of close. Surety of close is super important.
She has never failed me on a close. Might be
What
late
company?
by a day or two, but she closes.
What company is she with?
I'm gonna keep that to myself.
Oh, really?
Yeah. Oh yeah, but people can reach out to me if they want to. They're a super small shop, but they get it done, right? And
What? I usually promote everyone. I try and do what's best for them.
I also just want to be careful with what Tammy would want, given they're in a place of business right now where they're in incredible growth mode. So I want to make sure that I respect that.
Got it. All right, cool. Well, anyway, this was an awesome podcast. I'm happy you were on. And where can anyone find you?
You guys can check out techvestor.com. You guys can learn a little bit more about us. Hear podcasts we've been on, just like this one. And request to learn more if you're interested.
Cool. All right, my man. It was a pleasure.
Yeah, Allon, thanks so much for having me, and beautiful studio setup. Really into it.
I appreciate that.